This sounds like in this video we are looking at what is the stock market and how does it work. So the stock market is a place where investors can buy and sell shares, and it often represents the overall health of the economy. So the stock market therefore offers a way in which people can contribute to and profit from companies. Now the term stock market often refers to one of the major stock market indexes, such as the Dow Jones Industrial Average or the FTSE 100. Now their performance is viewed as representative of the whole market, so you might hear that the stock market has closed up or down today. Now if the economy is doing well, the prices of stocks tend to rise en masse in what is known as a bull market, whereas when the prices are falling, which is normally a sustained decline of more than 20%, it is known as a bear market. Now the stock market works for a number of exchanges, which include things like the New York Stock Exchange, the London Stock Exchange, and the National Association of Securities Dealers Automated Quotations, also known as NASDAQ. Now not every stock is listed in a major exchange, and some list their stocks on over-the-counter markets or the pink sheets. Now these have no reporting requirements. So next, what is a stock? As a share of stock is literally a share in the ownership of a company. So this means that when you buy a share of stock, you're entitled to a small fraction of the assets and earnings of that company. So there are two types of stock, common and preferred. Now common are the most typical and they are traded on stock exchanges. They allow you to vote in the company, and investors of stock get periodic dividend payments from the company. Now a dividend is a sum of money paid by a company to its shareholders out of its profits or reserves. Now if a company goes bankrupt, common stock owners are the last to get paid. Preferred stock, on the other hand, receives higher and more frequent dividends, which are not subject to the ebb and flow of the general market. If a company declares bankruptcy, preferred stockholders will also receive payments before common stockholders. However, preferred stock does have less potential for profit, and they don't have any voting rights either. Now, as stocks include sharing assets and earning with the public, it does beg the question why a company would want to do this. Now the answer is because a company needs money to either cover startup costs or to expand the business. Now the ways to raise money are either borrowing money, which is called debt financing, or selling stock, which is known as equity financing. The disadvantage of borrowing money is that the company has to pay back the loan with interest. By selling stock though, the company gets money with fewer strings attached, and the risk is spread out over many people. So this means that a company will offer shares in what is known as an initial public offering or an IPO. This means that the company are subject to detailed disclosure laws about their financial condition, operating results, management compensation, and other areas of their business. Now it's the shareholders who own shares of stock in a company, and collectively they are the owners of a company. So the shareholder can get a number of benefits from buying stock. Firstly, if a company grows and the stock price rises, then the shareholder can sell the stock at a later date for a significant gain. The corporation might also pay a dividend, which, as explained before, is money paid by a company to the shareholders from the profits or reserves. Now, very few young companies will pay a dividend or a large dividend because they may want to reinvest the profits to help the company grow and generate even more profit. A company may also suspend their dividend in times of economic difficulty. So finally, we're just going to look at what determines the price. As the stock market prices are not fixed, and the price of a stock will rise and fall based on free market forces. So this makes short-term movements very hard to predict. Now the supply and demand of a stock will help to determine its price. So this means that when more people want to buy it, the price of a stock will rise, whereas when more people are looking to sell, the price of a stock shall fall. So this is why a company who is prospering shall have a higher price, because more people are looking to buy the stock, whereas in a struggling company, more people are looking to sell. So thanks for watching this video. If you want a free share worth up to £100, click on the link below, conditions do apply. But thanks for watching and see you soon. Bye.